Hello everybody, this is chapter 7, video 2. So now we are on the second installment of these videos for chapter 7. We had looked at inflation, we looked at disinflation, we looked at deflation. We said we fear deflation more than we actually do inflation. Partly why is because the remedies that work for inflation don't work for deflation. This is all part of the outline, it's all part of the homework. I can't really, if I sit here and talk about everything that is related to these chapters, each chapter will need 20 videos. I'll be talking to you for hours on end. Nobody wants to hear me talk for that long. So basically, in a nutshell, what the government does when there's too much inflation is they do things like, adjust interest rates, adjust their own spending, change the tax rates in order for us to adjust our spending. But so we have more and we try to make it less. But subtracting is sometimes easier than adding. Adding can become more problematic. It's harder if people have more money and you kind of take away some of it or restrict some of it so they spend less, for instance. That's easier. It's much harder if they don't have much and you have to come up with money for them. So if somebody told you, which problem would you rather have? Too much money that maybe is wreaking havoc and you need to cut back, or not enough money? I think most of us will take option 1. And this is true for an economy. Now, how do we measure inflation? With the Consumer Price Index. About the past, we learned about what the real GDP measures. The real GDP measures economic growth. This is why it equals production, total output. What does Consumer Price Index measures? It measures inflation. It's just an index. And if you remember from math, an index is basically a point in time or a point on a scale that you compare to. It's a comparative tool. It's like if I said to you, are you getting taller? You need something to compare it to. Where were you? And how tall are people your age or the same sex or the same area? Or you need something to compare it to. And this is what this index is. So this index started at 100 points. And we go and see whether that is getting bigger or smaller. So if we start at 100 points, and we're taking that market basket and we're comparing it to the year before, and now it's 101 points, and we're going to go over that, how to figure out the CPI. It's actually very, very simple to do. But and it's 101, then you have a 1% increase in prices. And if it drops down to 98, then you have a 2% decrease. This is not about accurate calculations. This is about understanding the trend of things. Is it trending up? Is it trending down? Because then when you look at multiple indices or more than one index and compare them and see if what's it all doing, kind of like when we go to the doctors and the doctor takes our vitals. Now the vitals alone don't reveal that we do have a problem or don't, but they give us an idea of how likely we are and to what degree. If your heart rate is fine, your temperature is fine, your blood pressure is fine, your blood tests are fine, the odds are you don't have some major issue, but you take it all into consideration. If one of two of them are out of whack, now you begin to say, and if it's 3 or 4 of them, it's like bigger. So this is how we are analyzing, and this is where normative economics comes into play when we talked about it in chapter 1, and we said normative is about the interpretation of the positive. This is positive right here. This is Consumer Price Index. It's a measurement tool. It's going to give us actual numbers. Now, the Consumer Price Index has something called a market basket. Every year, we want to take the same things and compare them in price to see where were they, where are they. So here are some things in your market basket. Groceries, eating out, housewares, utilities. Your house that you live in, it could be rent, furniture, transportation, electronics, healthcare, prescription glasses. Don't forget those things. Going to the hygienist, going to get a tooth repaired, going to get your eyes lasered, going to get your skin lasered. All that is part of the equation. Insurance, education, getting a haircut, any other services that you do, getting your nails done, getting a massage, vacations, toys, all kinds of toys. I mean, what are adults if not children with more money to buy more expensive toys? This is like, it seems what we are. Entertainment, right? Going to the movies, buying tickets for the ballet, for a concert, landscaping, anything that has to do with everyday household expenses that aren't on the margin of only a few people consume them. That's why we leave out extremes. That's your market basket. You have a bunch of examples in the outlines that I have left for you, obviously. Now, the way we measure this is, here we are. Here's an example. So we take, this is the CPI for 2022, for instance. Now the year isn't over, but I just wanted to give you an idea. We are currently looking at approximately this much inflation rate, so I wanted to come up with numbers that kind of help with that. So for instance, we take the market basket, which has the same goods as the market basket from 2021. So we measure it. And based on this, the prices are higher. See how the market basket is $5.50 for 2021? The same goods, if we were to purchase everything in that basket all over again, we find that it is $5.98. Well, we deduct the last year's basket from this year's, and then we divide by the base, which the base happens to be the previous year. If you look at it down here, current CPI is right here. Cost of market basket in current period, that's your nominator. Cost of market basket in base period, there is such a thing as a base year. The base year is 1982, but a base year is the year you're comparing it to, which means you can compare the year 2022 to the year 2002. 2002 is down here. You're deducting 2002 from 2022, and then you're dividing by it right here, and you multiply by 100 to get your percentage. So if we were to do $5.98, the price of the market basket in 2022, $5.50, the price of the market basket in 2021. If you were to deduct that, we end up with $48. That $48 divided by the $5.50 down here, which is, the denominator, is going to give you a 0.087. You multiply that by 100 is how you come up with 8.7%. And this is approximately what we are dealing with right now. This is how the CPI is calculated. It's very simple, as you can see, and you're never going to have to calculate it. This is what the Department of, Bureau of Labor and Statistics is about. So they do it for us and we get these numbers, but just to have an idea. Now the CPI excludes income or social security taxes or anything that does not change the final goods or services. When you learn what something is, you should also learn what it is not. So it includes what changes final prices only for the household sector. So the CPI is highly attached to the consumption expenditure, not necessarily every other one. For instance, we have the PPI, the Producer's Price Index. That is in your in the outlines in the other reading materials that you have. But the really big one is the CPI. That's the one that impacts us more directly, and the PPI a little bit indirectly. Now, the CPI does not include anything that does not factor into the final price. So think of any expense where if it went up or came down, does not change the final prices of goods and services, like, for instance, the income tax. That impacts your income. It doesn't impact the prices. Well, then that is not going. Medicare, for instance, state taxes, anything like that will not affect the final price. Therefore, unless it does affect the final price, that's different. Like a sales tax is relevant because it's going to change the final price. So this is what it comes down to. Does it change the final price or not? Then it's counted or it is not counted. Okay, we're going to stop this video right here. We're going to pick up with real income next. You'll have a great one for now.